In the past decade, there's been hundreds of new millionaires that made it through investing in the markets, many of whom got lucky through speculation, but then unfortunately lost it all. And then there are others who became millionaires through value investing, which requires a set of skills. And this is probably the path I would take, and it's the one I recommend, because what's truly important is constant growth. In today's video, we will discuss one of the most important skills to grow and maintain your wealth by knowing exactly when to buy a stock with margin of safety.
Hey, what's going on, guys? Welcome back. For those of you who don't know me, my name is Diego Castrillon. I've been investing in the markets for quite a few years now, so I created this channel because I simply want to share my knowledge. Today's video, we're going to break it down into 3 sections. First of all, we're going to talk about a few things to avoid before you even consider buying stocks. And then we're going to continue with talking about a few words of wisdom from some of the greatest investors of our time. To finalize, we're going to talk about what it truly takes to buy stocks using margin of safety, which is what's truly going to reduce our risk and maximize our profits. So let's get to it. There are 2 things you must avoid. The first one is feelings and emotions. Feelings and emotions play a big part when buying a stock, and most of the time, it is what causes people to lose most of their money. Feelings like FOMO, which is fear of missing out, can make you buy stocks at a very high price, and then when stocks go down, panic selling kicks into gear. These emotions are caused by not having a plan. The second thing you must avoid is simply others. What I mean by others is simply avoid rumors. Avoid social media pages like Reddit and YouTube. I mean, it's okay to do research and listen to what others have to say, but you must not buy stocks because others say so. Many YouTubers and people that promote stocks are being paid to do so. So it might not be in your interest to buy stocks when they are promoting them through these platforms. I want to end this first point by reading one paragraph of one of my favorite books from Benjamin Graham, which I will leave a link down below just in case you want to buy a copy. So Benjamin Graham questions us, are you an intelligent investor? Graham defines the term, and he makes it clear that this kind of intelligence has nothing to do with IQ or SAT scores. It simply means being patient, disciplined, and eager to learn. You must also be able to harness your emotions and think for yourself. This second point is going to solve part of the question of when exactly do we buy stocks. Warren Buffett is considered to be one of the world's greatest investors of all time. And he says, be fearful when others are greedy, and be greedy when others are fearful. So what does this mean exactly? It simply means that we have to look at a graph with reverse psychology. When stocks go down, it is actually a good thing, because you can buy stocks at a better price. When they are going up, it is only good if we have fully built up our position. So we cannot hesitate when stocks go down, and especially if they are below our intrinsic value. Because if it's below our intrinsic value, that's when we create margin of safety. The first thing we must do is calculate the intrinsic value of the company we are buying. Intrinsic value is simply a mathematical calculation of what the company's actual market cap is. In other words, when we buy a stock, we must look at it as if we were buying the whole company. And we must calculate what that price is. There is a simple calculator online that I normally use, and I will leave the link down below. Hey, what's going on, guys? All right, so for this part, please go ahead and get some coffee because this is one of the most interesting parts. All right. So, when it comes to actually calculating the intrinsic value of a company, you might want to keep it simple. And there's a very simple calculator that I'm going to leave a link down below. Actually, you might want to go down below and click all 4 links, because I'm going to leave a link of Yahoo Finance, the Treasury Yield, and Stock Analysis website, and obviously the calculator. So these are 4 websites that I use almost every day. They are very important because, I mean, this is how we're going to identify, and this is where we're going to do our research to know if we're actually getting a good price for our stocks or not. All right. So let's go to the buffettbooks.com, and here we're gonna see that it's gonna be divided into 2 sections, right? We have the top and the bottom part, and the top is simply asking us what is the current book value, the old book value, and the number of years in between. This part is simply to get an average book value change per year. So we wanna identify how much the company has been growing for on average per year for the past 10 years. So we can have a better understanding of what we can probably expect for the next 10 years to come, okay? So for this part, we're gonna have to go to stock analysis, and let's put an example of one of my favorite companies. We're gonna talk about Walgreens Boots Alliance, right? So go ahead and type in the symbol of any company you wanna look for, and let's go to financials, and then we click balance sheet, right? Here it's telling us all the balance sheet per year for the past, decades and decades. So we have 2020, and if you scroll all the way to the bottom, it's gonna say book value per share. This is the metric that we're looking for. So the book value per share for 2020 was $23.47. So that's what we're gonna input here, $23.47. And then again, since we're looking at the past 10 years, we wanna get the old book value for 2010. So if we click these arrows, it takes us back all the way to 2010. And we see what that book value was, which was $14.67. Okay, so $14.67. Again, 10 years, and we hit calculate. So that gives us an average growth rate per year of about 4.8%. So just go ahead and copy this, and we're gonna paste it down here where it says average percentage change. And then let's go to number 1. So cash taken out of the business. This is section 2. Cash taken out of the business. Let's just go to Yahoo Finance. We type in the signal one more time, Walgreens Boots Alliance. And if you scroll down just a little bit, you're gonna see the forward dividend. So the dividend is $1.87, right? So we simply type that in here, $1.87. And then the current book value, we already know it's $23.47, which is what we inputted here. So how many years are we gonna look forward? Let's look forward at 10 years, right? Since we already identified that the growth rate for the past 10 years is 4.8%, now we're gonna put 10 years to calculate how much the price is gonna be for the next 10 years, right? And then the 10-year federal note is the daily treasury. So just go to Daily Treasury, the website, and look for today's date. So today, the 10-year note is at $1.60. Sorry, or 1.60. We're gonna put that there, 1.6, hit calculate, and voila! We've identified that the intrinsic value for Walgreens Boots Alliance today is $49.20. All right, so that concludes this first part. How to identify the intrinsic value of the stock. All right, guys, so now let's talk about margin of safety. We have identified the intrinsic value of the stock. So what is margin of safety exactly? Here, I'm gonna pull up this chart, which is gonna explain it real well, right? We know that the intrinsic value of Walgreens Boots Alliance is at $49.20. So what is the current stock price? Well, the current stock price is $54.53. So the stock is at about here. It's a little over our intrinsic value. So we obviously don't wanna buy this stock yet. But what happens if in the future the stock drops and it drops about 10% below our intrinsic value? That's gonna be around this green zone here. And that's exactly what I look for. Before I buy a stock, again, we calculate the intrinsic value and we wanna look for that margin of safety of about 10%. That's when we aggressively buy to minimize risk and maximize profits in the long term. All right, guys, let's conclude this episode. So, we learned that we should avoid speculation at all costs. We should not listen to our emotions or our friends. Being greedy when others are fearful and be fearful when others are greedy is simply one of the best phrases you'll ever hear. Remember, when stocks are dropping, that's when opportunity comes because stocks drop below our intrinsic value. When stocks drop below our intrinsic value, that's where we create that margin of safety. Remember, the more the stock drops below the intrinsic value, the more margin of safety you have. So that's room for error. Okay? Guys, I hope this video helped clear it up that speculating and buying stocks on hopes is not actual investing. Investing is doing your own research and having exact price targets and a good vision. So when stocks drop, instead of panic selling, you actually make more money.